Hello Sector Watchers, welcome to the 30th episode of Sector Spotlight on Tuesday the 12th of May. I'm recording it on Monday the 11th of May. We'll be starting off the show with a quick overview of what has happened in asset classes and sectors using relative rotation graphs over the last 5 days. And then I'll try to highlight a couple of interesting rotations that have been taking place over the last 5 days, both on an asset class level and on sectors. And spoiler alert, one of the interesting tales is for the technology sector, for XLK. And what I'm going to do is I'm going to dive into that technology sector and pick some interesting tops, but also some flops that you should avoid in that sector, because it is one of the sectors that most people look at. We will also take care of at least one question from the mailbag, and there will be a new trading idea towards the end of the show. But let's first have a look at what happened last week. On the left-hand side, the RRG for asset classes on a daily basis for the last 5 trading days. So that's Monday to Friday, I should say. And we see that it was actually a very good week for stocks and commodities. And the weakest asset classes were government bonds and corporate bonds. The benchmark itself up 2.2%. What is interesting is that on a daily scale, we see the rotation for stocks curling back up, inside weakening, back up towards leading. And the opposite for government bonds, inside improving, rolling over, heading back down to lagging. This suggests that the temporary, I don't know, if we look at let's first go to the weekly one. We see that government bonds are still way to the right and stocks are in the lagging quadrant. But here you see that stocks are, well, last week started to curl up and government bonds started to lose a little bit of momentum and roll over. There's no doubt that on the weekly scale, the preference is still for government bonds. Despite the big rally that we're seeing in stocks, the longer term picture shows relative strength for government bonds. This is still a risk off message. However, with those big swings and what we see in the market right now, it looks as if that recovery rally, if it's still a recovery rally, I don't know, but this suggests that it has a little bit more to go. It's actually heading back towards the leading quadrant. So for the short term, stocks are again picking up relative strength versus the benchmark and versus bonds. On the long term, bonds are losing relative strength, stocks are picking it up, but it's still a long way to go before that turn has come. So I think the conclusion should be that still very cautious for the long term, but the shorter term is still looking good. It's actually picking up a little bit of relative strength again so far for asset classes. So please keep an eye on this because this looks to be an important rotation. If we go to the same image for sectors, we see that the rotation for that actually, let me sort it here. It was a very good week for energy and technology and communication services, and also for discretionary. And here is the benchmark SPY up 3.4, but energy was up 8 and technology up 6.6. Weakest performance for utilities and staples, let's say the traditionally defensive sectors. So market is looking for aggressive growth type sectors. And the sector that I want to focus on today is technology, because this is the last 5 trading days. Now let's go back 1, 2, 3, 4, 5. This is when we spoke last week. This is Monday of last week. XLK was right smack in the center of the RRG, and during the week, and this is Friday, you see that technology has actually accelerated into the leading quadrant, pretty much picking up a leading role again. And if we line that up with the weekly version of the RRG, we see that technology rotated, rolled over, and just it hooked up. If we zoom in to this rotation, we actually see that the rotation was so fast that we got a hook to the right on that weekly tail, which is caused by that quick acceleration on the daily RRG, which means that technology is a sector that we need to dive into a little bit further, which is exactly what we're going to do right now. At the right hand side, here is the chart of the technology sector, XLK. What we see here is, you know, everybody has seen this chart, the rapid recovery out of that low that was set around 70. The price is now approaching the gap area between, let's say, roughly 96 and 98.5. That will be an important area to watch because there is potentially resistance coming in. However, that move is very, very strong, and especially the relative picture of XLK versus SPY pushing to new all-time highs. That is a very positive thing in my opinion. And you see the RRG lines making that very quick high-low rotation. That is what causing that hook that we saw on the RRG for the sectors. Now, if we dive into the individual stocks in the technology sector, I've loaded them up here on the RRG. It's a big sector, so it's a crowded space on the RRG canvas. As you know, we can toggle through all these individual names by simply holding down your control key and pressing the down arrow keys or up arrow keys on your keyboard, which will help you to browse through all these individual names and look at the rotations. I've done that for you, and I've narrowed down the selection of these stocks to about 10 names that I think are showing interesting tails, interesting rotations. And as you know, I think it is at least as important to know where you should not be invested as to look where you should be invested. So I'm going to talk you through some of the tops and flops inside the technology sector. And let's start with the flops because they are pretty clear. The first one is HPQ. Let me highlight that here. That's that long tail shooting into the lagging quadrant. The reason is very clear, that relative strength is making lower highs and lower lows. Very recently broke to new lows. RRG lines nosediving. And as you can see, this recovery is nowhere near the recovery of the sector. It's still, you know, hovering around here below that 16 area, which is an important resistance area. And I don't think that HPQ will make any meaningful move to the upside in the weeks to come. So this for me is an avoid. This is one of the flops. If we move on to CTSH, Cognizant. Let's highlight that on the RRG. This one rotated from improving back into lagging, and we know that that is a weak sign, and we can exactly see why that is on the price chart and the relative strength lines. It's stalling inside this resistance area between 57.5 and 60. 2 weeks ago already we made 60. We didn't go higher above the last 2 weeks, which was strong for stocks. And we're about to break to another low in relative strength. And you see here that rotation from improving back to lagging. So CTSH, another flop in the technology sector. And the third one that I would be very, very careful with is IBM. Look at the rotation on the RRG, again rotating from improving into lagging, and you see that the price is stalling in this resistance area near 125. There's plenty of room to the downside again, and we see that relative strength is still in a very clear downtrend and potentially breaking to a new low here. Now to the good stuff. CDNS, Cadence Design, that is well inside the leading quadrant. pushing further into it, and what I really like is the fact that it is pushing to a new all-time high in price. So that is a very positive sign. On the relative picture, we are not there yet, but this low is clearly in place and the RRG lines are pushing higher, so Cadence is definitely one of the stocks that you may consider picking up inside the technology sector. Another one is PayPal. That is a tail that we cannot and should not ignore. It's very strong. The price move has also been very strong, and this for me has gone too far. Clear that break above 125, super strong, not to be ignored, but I wouldn't chase it. This is definitely one that I want to have on my list when it comes back. RRG lines are well above 100 and moving higher. Synopsys, inside leading and has a little bit more to go. It is pushing against all-time highs, against that previous high. If that breaks, that'll be very good for new fuel for relative strength, and it'll keep and push the RRG lines further above the 100 level and S&PS further into the leading quadrant. So definitely one of the tops inside that sector. Let's quickly move on to Cisco. That price doesn't look very well. That relative is hovering above a low, but the tail is actually pointing towards leading. So it's not as strong as the previous three, but keep an eye on it because this could be a reversal, but it needs to actually overcome the resistance that we're seeing right here, and it should not break below that previous low in relative strength. So careful, not a top, but potential. KLAC is something like neutral, but the tail is starting to move. If we can keep up that trajectory towards the leading quadrant, and if we can break above that previous high, then KLAC could be one of the more interesting stocks inside the technology sector. And I have two more to go before we finish off this segment. Apple, of course, cannot ignore it, should not avoid it, but what we see here is inside weakening and starting to curl up again. And we know that that is a strong sign. And look at the relative for Apple, it's almost pushing to a new high. If we can do that, and if we can keep this above 100, we will have the rotation back towards leading, and Apple will very likely pick up its leading role inside the technology sector again. And then the last one that I want to share with you is INTC, Intel. Not so much because of the price or the relative chart, but if we zoom in on the RRG, we see that it is actually curling back up. It was inside weakening and it's starting to curl back up and hook back to the leading quadrant. So I'm keeping an eye on this as a surprise stock pick. Watching resistance between 62.5 and let's say 63, where the gap area is. If that breaks and relative strength breaks, INTC, Intel could be another interesting pick inside the technology sector. So here are your tops and flops for the technology sector right now. The mailbag. As you know, you are always welcome to send your questions, feedback, remarks, anything you like to share with us at juliusdk@stockcharts.com, and I'll try to answer most of those questions in the mailbag segment of Sector Spotlight. These are actually, I've got two questions that I want to combine into one because they all have to do with benchmarks. So that's what I will try to, wrap things up, and if stuff comes together, I'll create one segment for a similar subject. This one is about benchmarks. A lot of questions are about benchmarks, and that's totally fine because it is one of the maybe the most important aspect of an RRG. One question comes from Brian, and he says, I really enjoy your chart. The effect of $1 is to eliminate a benchmark and thus compare all tickers in the portfolio to each other, question mark. That is, if there are 4 tickers with $1 as the bench, they will all be compared to each other over the relevant time frame, question mark. Do you get the same effect in the alternative by just entering one of the tickers that is being compared, question mark? That is, if you have, by example, XLU, SPY, LQD, and IEF, and you set the benchmark at IEF, the chart will compare all of the tickers to IEF, so you will see the relative performance of all 4 to each other effectively, or you can use $1 and achieve the same result, except that it will be more pure in terms of the deviation from 1 to 0. Remember this? I'll get back to it. And the other question is, and this one is actually already 2 months old, it's coming from Andrew, and you see sometimes I don't answer them right away, but they'll be in the stack and on the shelf, and I will pick them out when I think it's appropriate. But this one says, viewed your show last night, thanks for that. Quick question on RRG. I was reviewing Canopy Growth versus the S&P or versus SPX and HMMJ ETF as the benchmark. Completely different results. Which do you recommend as the better benchmark? And then Andrew was smart. He said, if you do happen to do an example of this, can you do it for wheat.to, Canadian wheat.to versus SPX, SPTHC, and $HMMJ? That would help. Have a good weekend. I will need to go to a screen, and then I can show you and try to show you and explain how this all works. On my screen, I have prepared the 2 RRGs with regard to the questions that we are going to discuss. So on the left-hand side, we have that RRG where the question of Brian was the effect of $1. So you got the 4 tickers that he mentioned against the $1 benchmark. And as he says, you can actually compare the relative trends, the relative performance of all these ETFs versus $1, which is the absolute benchmark that never goes down. You can see that because it's a straight line here in the brush chart, and you can see the interaction between those ETFs on that screen, so you can actually see how they interact against each other and what their relative trend is. Always the most important measure is the JDK-RS ratio. So based on that, you can basically start working from the right at the high level, where you can say that IEF at the moment, so it is now May 11, is the strongest of these 4 in this universe, followed by corporate bonds, LQD, and then you got XLU, and then you got SPY. Now, the question was, what happens if you change $1 to IEF? And you can actually simply do that by just typing IEF into the benchmark box. And now you will see that IEF is the benchmark, and you see the others here, and the interpretation still remains the same. The picture looks a little bit different because we've moved the benchmark, but the relative position of those tails versus IEF is still the same. So let's move back to the $1 example. Then we had IEF here, LQD lower left, XLU further to the lower left, and then SPY above XLU. So keep that in mind. Oh, as a matter of fact, you know what I can do? I can actually just simply duplicate this and move it over here, and then change this to IEF, and then you can see the difference. Well, there you go. So let's put this in the middle, let's center this, and you can see that LQD is positioned slightly to the lower left from IEF. It's still the same. Here it's little bit above 98. Here it's a little bit below 98. That's because IEF came all the way down, and we're further to the left. We're, you know, below 95, where we are here above 97.5. But it's this distance that we need to look at. The relative position for XLU and SPY is exactly the same. Slightly different because we now have the difference with IEF and $1 to take into account. But SPY is above XLU and it's above XLU here. It's exactly the same. Say that we would like to change now this one to LQD. You will see a similar effect. IEF above LQD, that's now over there, and you see a similar behavior for SPY and XLU. So changing the benchmark does not change the relative position of all the individual items on the chart against each other, but it moves it around. And because LQD is moving against $1, you will see that the rotation and the tails are a little bit different, but the dotted position of each item is the same and remains the same. So I hope that clarifies this question. Now the other one was related, and it was Canadian related. It's coming from Andrew, and he said, I'm comparing wheat.to, so that's Canopy Growth, quoted them on the Toronto Exchange, versus SPX, and that gives this image. And let me do the same with this and put that one here. And now we do wheat. Let me take these off. Wheat against HMMJ.to. Oh, the roll again. That was not what I wanted. I need wheat. So now you can see the difference. You can see wheat.to versus SPX and wheat.to versus HMMJ. Completely different. Yeah, it's completely different because the benchmark is completely different. So if we now would tick on SPX on this one here, and we would tick on HMMJ here, you see the similar effect as what we just discussed with the 4 ETFs on the previous graph. Let me center this chart and let me center this chart. Now we have HMMJ, which is right here, and we've got wheat, which is down there. That's exactly the same distance. And we got SPX, which is the center on this one, but it's here, and you see that relative position. Maybe if I just make them like that, and we don't get the distraction from the tail, but you can see that these, it's all about the relationships of the various positions. The tails will show slight differences, not massive, but slight differences, because the tail of the benchmark is also using against the tail of the other benchmark. If we would, you know, if we're now looking at HMMJ or SPX as the benchmark, that has an influence on the path of the tail. But the day-to-day, or in this case, the week-to-week positioning of these items are the same. So even if we would, you know, move 1, 2, 3 back, and here we go, 1, 2, 3 back, you will see that that position remains the same. Let's just move to, I don't know, something October, center it. We do the same here. We go to 1st of October, center it. And now you will see here HMMG is the benchmark. Here SPX is the benchmark, and you see that the alignment is exactly the same. No problem. This is important. This is quite crucial to understand how RRGs work, so I'm happy to answer these questions. Please keep them coming. I hope that this answers the question for this week about the two that we had from Brian and Andrew, actually. This week's pair trade idea is actually coming from what we discussed last week in Sector Spotlight, I just didn't have the time to come up with the idea, or at least properly present it. It's following the seasonal pattern that is aligning with the rotations on the RRG for the communication services and the financials sector. If you want to see how we did that, just go back, go on the YouTube channel and find the 29th episode of Sector Spotlight that was dated on May 5th, and you will find the rationale for it. What we saw there was actually communication services moving into the leading quadrant, backed up by a strong seasonal pattern for the month of May for this sector, while financials is moving into the lagging quadrant and backed up by a weak seasonal pattern for the month of May. Now, this is the weekly RRG, and we have the daily version here where you can see that XLC continues to move to the right, lost a little bit of relative momentum over the last couple of days, but financials have actually turned around and started to head lower again, downward to the lagging quadrant on the RRG daily. Now, if we put that on our trading idea list, pair trading idea list, we got this chart here. So I added it here on May 4th, May 5th when I recorded that. You see that is underway now. It pushed to a new high. This is the ratio of XLC versus XLF, and these are the bar charts. So we're going to monitor this pair trade idea, long communication services, and some sort of short exposure to the financial sector. And this concludes this week's episode of Sector Spotlight. Ladies and gentlemen, thank you for watching. If you're watching the show on the YouTube channel, please don't forget to like the video. And if you have any questions or remarks or feedback, please put it in the box below and I'll answer right there. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Meanwhile, if you want to stay up to date with relative strength and RRGs, please go to the RRG blog on StockCharts.com and subscribe using the link below each article. Stay safe and hope to see you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.